So today what we have for you is we're going to go through, it's a normal format that we do each year. It's the same template. It seems to work. We love your feedback if you think we can do it differently and better. But Justin Hahn is our in-house economist. He got his degree from UBC, and he's going to tell us why a year ago we, due to the 3 interest rate increases by the Federal Reserve, we entered 2019 with a little bit of trepidation and declining economic indicators, and what happened in 2019 and what we're looking for 2020. Then Wayne Michel is going to follow up, given the surprise good news, not really surprising, but certainly the optimistic news that came out of 2019, where we are going in 2020. He's going to spend a little bit of time talking about how the makeup of the market movement, even though we're in record territory, was so narrow and really driven by the technology stocks, and there's still lots of movement available in the stock market from more boring value-based companies. He's also going to finish with interest rates and why we think they're low and going to stay low. Next will be Ian McKinnon, who comes from Addenda. Addenda's managed the bonds at Genus since 2008. We have a wonderful relationship with them and with Ian, and thank you for coming. He's going to talk about a little bit of security selection, how they pick the corporate bonds and the mortgages that we use in your portfolios. And finally, we have Mike Thiessen, who's been at Genus for 3 years. He's our Director of Sustainable Investing. He comes from Abbotsford originally, but we hired him out of Cambridge, where he got his master's in sustainable investing. So he's going to talk about not the way you think about sustainable investing in terms of eliminating the bad guys, but more what we do at Genus when we're focusing on owning the good guys. And finally, I'll come back at the end to just tell you how we're doing. Are those consistent returns still in place? So, Justin, what happened in 19? What are we looking for?
Thank you, Leslie. Okay, so 2019 began with a lot of uncertainties and fears in the market and the economy, and lots of indicators that were flashing. So we see that in 2019, the biggest worry we saw was heading into late 2018, the Federal Reserve has raised rates 4 times in the year. We also saw money supply growth slow and the global monetary base shrink for the first time since the recession. We also saw some of the economic indicators begin to deteriorate, such as the OECD Leading Indicator Index and the Purchasing Manager Index. We also saw midway through the year the yield curve invert unexpectedly, as well as the US-China trade conflict escalate further and Brexit be pushed further down this line. In 2020, those fears kind of got resolved, and so the Federal Reserve reacted by cutting rates 3 consecutive times. We also see that quantitative easing number 4 is underway, and the Purchasing Manager Index is looking to bottom, which I'll show you in later charts. We also see the yield curve re-steepen quite significantly and quickly as recession fears begin to fade away. We also saw a phase 1 deal signed by US and China last week, and Boris Johnson win a majority and promise that Britain will leave the EU by the end of the month. So, in 2019, as I mentioned, we saw the Federal Reserve increase their rates 4 times during 2018. But in 2019, they took a turnaround and cut rates 3 consecutive meetings. Usually, higher interest rates are bad for corporations, and we become more weary of the economic situation. That's why we were more of a cautious stance, holding more dividends, being more defensive to start the year. But during that time, we also saw that unemployment rates in the US were at historical lows and also remained really low. Usually when unemployment rates are really low, we find that wage pressures begin to climb. We saw in 2018, while the Federal Reserve was increasing their rates, we saw wage pressures begin to build. But after they cut rates and the unemployment rates began to stay there, the wage pressures disappeared. In addition, the Fed has also come out and said they're symmetrically going to target the 2% inflation rate, which means that they're not going to raise rates quite fast. They're going to let the inflation hit maybe above 2% before they react. Normally, they would react right away just to combat inflation because they don't want the economy to overheat, but inflation has been persistently low across global economies, so they're more fearful of that. More indicators of the Fed turning more accommodative and taking a more dovish stance is shown in their balance sheet. So this chart represents the monetary base of the US, China, and European balance sheets and their growth rates on a year-over-year basis. So from this chart, we can see that at the beginning of the year, around 20, declined significantly. But we've seen a rebound since then. Most of the movement in this chart here is due to the US Federal Reserve. Last year, you might have heard some news about the US Federal Reserve unwinding their balance sheet, and this was the result of that. We finally got negative balance sheet growth rates. But the Federal Reserve realized they made a little bit of a mistake, so they began to print money again and cut rates, as I previously mentioned. We view this more as a quantitative easing 4 regime, just because it is much faster and much more extreme than it was during previous times. This steep downtrend is also another reason we are more cautious and defensive heading into 2019. We also saw other market indicators flash signals. So the yield curve I mentioned before turned negative for the first time since the recession, and that was in the news quite a bit, but it only lasted for a short amount of time. This was because the Federal Reserve reacted quite swiftly and realized that they did make a mistake. So the yield curve just represents the longer end. In this case, this is the 30-year US bond yields, and which are generally determined by investors and how they perceive the ongoing economy. And the short end, in this case, is the 3-month yield, which is more determined by the US Federal Reserve. So currently, the US 30-year yields are yielding at about 2.2%, while the 3 months are yielding 1.5%. So the spread difference between the two are about 0.7%, which is above the 0%. So an inverted yield curve just means that the shorter end is yielding higher than the longer end. So that's why we get negative yield curves. So why do we focus on monetary policy so much, and why do we look at it and care? So this next chart here, we can see that the red line is the global money supply, a year-over-year change, and the blue line is the global PMIs. So from this chart, we can see that the global money supply usually leads the real economy by about 9 months. This is because it takes time for these effects to filter through to the economy, and that's also a reason why we saw PMIs start to shrink. But if you look at this chart, we can see that the two lines are closely following each other, and the red line predicts the blue line. So the blue line, which is Global Purchasing Manager Index, per PMIs, which represent corporate sentiment, looks like it's bottoming out and it's due for a rebound in 2020. So we expect the economy to the global economy to rebound slightly in the next year and during this year as well. With the growth rates coming above the 50 mark here. So 50 usually means that if it's below 50, the economy is contracting, while above 50 means it's in growth. So to summarize, in 2019, we saw a lot of uncertainties and geopolitical issues coming into the year, but in 2020, those fears and uncertainties actually became fuel for the markets. We expect it to become fuel for the markets as well as the economy. So what does this all mean from an investment perspective? I'll pass it over to Wayne to discuss that portion.
Well, Justin just talked about some of the good things that happened in 2019, and because of that, the market obviously went up, and it's been a nice run. So I'm here to tell you the hard part, what happens next, obviously. You know, it was a great year in terms of the Fed changed course. They eased 3 times, and you know, with the problems in the repo market, where a lot of concerns, it got the Fed to expand their balance sheet dramatically to try and tamp that problem down. We don't know why that problem's out there. People think it may be a hedge fund in trouble. It could be a European bank in trouble, but they're definitely in there actively expanding money supply to help cover that one issue. And I think they're going to tamp that down. And that's got the market excited too. That's when the market started to really pick up. And of course, you know, a pause, if you will, in the trade war. We still think that's a long-term issue. It's not going to go away for years and years and years between China and the U.S. But at least now it's been put to bed, I think, at least until after the election. So it's sort of a timeout. And we'll see where that goes. So lots of good news in the market. And where do we go from here? Looking at the market from a valuation perspective. Here we have three different valuation metrics going back to about 2000 for the Europe, the green, Canada, the red, and the US, the blue. And what we do is we look at, we're number one, we think the markets are still fairly valued right now. The US obviously is a bit richer. If it's low, it's expensive. If it's high, it's cheap. US is a bit expensive right now. It's probably the sentiment too. It's probably a bit overbought. There's a lot of positive news built in there. We could get a short-term correction, but longer-term valuation doesn't look that bad, given where interest rates have come from. We now have T-bills back to 1.5%. And all we do here, for example, how we get the number for the US of around 4%, we take the forward year earnings on the S&P 500, which are about 180, divided by 3,300, which is the number on the S&P, and you get around 5.5, less 1.5% for the T-bill. You end up with a 4% spread between the earnings yield and the T-bill. So you can see, in 2007, 2008, the market was very expensive and became very cheap into 2009. So the U.S. is, fairly valued to a bit on the expensive side, and Europe is still cheap, but who cares? They still have issues to deal with, and Canada is fairly valued. So U.S. has been the best performer, and it's because it does have the best growth rate. If you look at their earnings numbers, and why it merits a higher PE as well, because it is a stronger growing market. You can see going back to 2010. In 2010, earnings for the S&P and for the rest of the world were the same. Since then, U.S. S&P numbers have doubled, whereas Europe's been flat. And what's driven that? Well, there's more multinationals that have taken advantage of globalization. We also have more technology. The U.S. market now is about 30% of technology, so they're growing a lot faster. Their earnings are growing a lot faster than the rest of the world. And of course, we had the big bump you can see in 2017-16. That was the Trump administration tax cut that really jacked up earnings. We also put in the forecast here, the consensus forecast, which are usually always wrong, but they're in here for 2020 and 2021. Pretty flat in 2020 and some acceleration in 2021. So in general, the U.S. is growing faster and merits a higher PE. So based on where we are today, how do we see the rest of the region stacking up against the U.S.? This here is these are our asset allocation models. We have around 20 different models to look at asset class, equity on a regional basis, our bond market, and commodities. And one thing that you want to jumpstart right away is the equity space. If we look at different pairs, for example, world versus cash, it's right now we're neutral. Blue is neutral. In a case here of S&P 500 versus U.S. bonds, it's green. That means that the left pair, we're overweighting the left pair versus the right pair. So we're favoring S&P 500 versus U.S. bonds. So right now we're neutral on world equities versus cash. We favor stocks over bonds, and we prefer, in this case here, we prefer cash over bonds. Now looking at the regional weightings, as I mentioned, on a regional basis, we see we're neutral between the U.S. and the rest of the world for the first time probably in 5 years. And so we think we're seeing a bit of a changing of the guard here. We still like the U.S. longer term, I would say, but over the next couple of years, we expect, as Justin said, we see the global money supply turning around, improving, which will bring the economies around as well. And in that environment, a stronger global growth, we think in the next year or two, it should help the emerging markets, should help Europe, and even should help Canada as we have a global stronger growth. And so from that perspective, the rest of the world can catch up to at least do as well as the U.S., if not better, in the coming year or two, we think. We're also seeing within the cyclical versus defensive neutrality and value versus momentum. I'll talk more about value by momentum, the internal parts of the market going forward. On the bond side, we're still favoring corporate spreads over government bonds and high yield. They've done very well, but they're still going to do well in this current environment, we believe. And on the commodities, we're seeing some of the commodities go green in terms of liking oil, liking gold, liking copper. And that's usually a good sign for the economy going forward. They call copper Dr. Copper. As copper goes, so goes the economy. So our perspective right now is sort of neutral across the regions. We still like we're neutral on global stocks versus cash, but we like stocks better than bonds and cash better than bonds at this point in time. So let me look at the sort of some of the internals and what actually happened in the course of 2019 and where we go in 2020. Last year's performance on the Standard & Poor's 500 was really a large cap growth environment. And really it was a mega cap a growth environment where some of the largest companies in the world, Apple, Microsoft, Alphabet, Facebook, and Amazon, those 5 stocks were accounted for 25% of the returns of the S&P 500 over the course of the last year. And of course, the flip side of this is when these mega growth stocks outperform. What underperforms is value-driven stocks and smaller cap names. So it's been a really concentrated market over the course of the past year. And these things don't usually last. And we think with the economy improving next year, we'll see value starting to perform a little better. In fact, if you look at value over the past 3 years, it has underperformed. Underperformed in 2017, was flat in 2018, and underperformed in 2019. So we have relatively 3 years of underperformance. We don't think this is going to continue going forward. And one of the reasons is if you look at the spread in valuations between value stocks and the market, value stocks are dirt cheap, right, at this point in time. What we do to get this metric is we look at the cheapest stocks, the top 20% of cheap stocks, and look at them on a book to price and price earnings basis and measure their disparity. In this case here, we're looking at the forward PE, look at their disparity between the marketplace. And you can see back during the tech bubble, I'm going to try and move again, hold your breath. Back in 2000, the spread between value stocks and the market was about almost 6 multiple points. And at this point in time here, the forward multiple in the S&P 500 was 25, and value stocks had a multiple of around, would have been 19, right? And you can see it got very narrow in 2010 when value stocks really did well going into the recovery, and there was no valuation gap between the market and value stocks. And once again, we're back in this range right now, where there's a big gap between value stocks and the rest of the market. The gap is around 5%. The market has a forward multiple of around 18. That means that value stocks multiple is around 13 at this point in time. So very similar to 2001, except the market overall, we believe, is in better condition than we were back over here. There's the multiple points, 25 versus 18 for the market, and value stocks had a multiple of 18 versus 13 right now. So we think there's more value. This was crazy back in 2001. Also, another factor is that interest rates are so much lower than they were back in the tech bubble. Interest rates on the long bond, I think, were around 5% at that point in time. And now they're 1.5% to 2%. So much lower rates, lower multiple. So from an overall perspective, markets in better shape, and value stocks we think are cheap right now. And also going into 2020 and 2021, we think as I mentioned, the global economy is going to improve. And typically in that kind of environment, value stocks do better. And the fact is that if the investors can see some kind of visibility on where the economy is going, they can then start trusting the E and price earnings and the P and PE. They can start trusting earnings going forward, and they'll invest in them. And typically, value stocks do better in that kind of environment. So we think there's going to be, number one, there's a big gap between the market and value stocks. It's like an elastic band that's been stretched, and usually that snaps at some point in time and comes in. Plus, and that'll be, we think, helped by the fact the economy is going to get stronger and better in the coming couple of years. And that'll help value stocks as well. The same kind of story for dividend stocks. This is a similar valuation, looking at dividend stocks versus the rest of the market. And they remain cheap right now. They're comparable to 2008, comparable to the tech bubble. And number one, dividend stocks are value, or a dividend strategy is a value strategy, so it'll move with the value strategy as well. And right now, in our conventional dividend strategy, we can get a yield of 3.75. There's lots of opportunities out there, a lot of stocks out there with good dividend yields that have been left behind by this market. And also, our fossil-free dividend strategy is yielding 3.25, and that compares to the 10-year yield in Canada right now is yielding 1.5%. So, if you want yield, you can get in the dividend strategy and value stocks that we think represent good value. So, in 2020, we see value and dividends doing better, and this is reflected in our portfolios as well. Here's a strategy footprint of our portfolios, and I want to focus on the value box initially. From a value perspective, we have our dividend fund, our CanGlobe strategy, and then the analog to that in our fossil-free space, our dividend strategy, and our fossil-free CanGlobe. So we have conventional, and so we have sort of regular coffee and high test, if you want to call it that, here. And you can see the number of holdings compared to the benchmark. You can see our dividend yields, right, as advertised dividend in the 3.7 in our conventional and 3.2 in our fossil-free. And here we have the enterprise value to EBITDA. That's sort of what people use in the international space as a proxy for PE. Look at the earnings before dividends and taxes versus or sort of enterprise value, which includes equity and debt versus EBITDA. And you can see that across our mandates, we're lower than the benchmark of 13.2. And our benchmark in this case here is 35% the TSX and 65% MSCI World. So looking at our footprint, more value, more dividend yield in our dividend strategies, and also a little bit of a lower forward earnings growth, except for our fossil-free CanGlobe. It tends to have more technology because it doesn't hold energy stocks, and to make up for that, it looks at other stocks that have correlation to economic movements like tech stocks, banks, consumer discretionary, and telecom. And also another feature of our strategy is lower debt to equity than the market, and also higher return on equity. So we think in the coming year there's going to be more of a focus on value, and in that kind of environment, earnings visibility does matter. So this looks at our overall portfolios and how they're positioned. I'm going to look at some of the strategies in terms of what we have in them, and I'm going to start off with our dividend strategy. And what we've done here, the next couple of charts, is we've put up our active weights. And what I mean by active weights is we take the weighting of a stock's weight in a portfolio less the benchmark weight. So for example, Bristol Myers Squibb has our biggest active weight in our dividend strategy. It's about 3.5%. So it's probably in the benchmark, it probably is 50 basis points, if that, I would suggest. So we probably have around 4%. At a nominal basis, less the benchmark of 50 gives you around 3.5%. So our biggest active weights, all surprisingly, because number one was what do we do every month at Genus is we rank all our stocks in our 2,000 stock universe across the world. We give them a ranking from A to F, A being high, F being low. And then we use risk models to help us create these portfolios and create a portfolio, in this case here, with a dividend yield of 3.75, and with beta somewhere, or market sensitive somewhere between 0.75 and 0.85. And right now you can see these are our biggest active weights. Most of them all have high ranks, and the what color is that? This pink denotes value stocks, and the blue denotes growth stocks. And so, as you would expect in a dividend strategy, all our big active weights are value stocks. And the stocks we have negative active weights like Apple and the rest here. There's a lot of more growth in there. For example, Microsoft, Facebook. There's not much yield in these. There's some yield in Microsoft, and there's not much yield in Shopify and Amazon there. Not much earnings there either. So that gives you a perspective on our active. Oh yes, within this strategy we do own Microsoft, but our active weight is is minus 1%. So its weight index probably is around 2%, and the benchmark is around 2%, and we have 1%. So ergo, we have a negative active weight of 1%. So looking at our CanGlobe strategy, now you're going to see here are active weights. We've got CGI Software in Canada, Air Canada, Bristol Myers, Kirkland Gold, growth stock, NVIDIA, Nike, Manulife, it's a value play. Nippon is somewhere in the middle, AMD, and MasterCard. So it's a mixture of growth and value. And this is more of a growthy strategy, beta close to 1, and it's definitely has a mix. Our models are a mix of value and growth. We try and diversify styles. And on the other side, you can see here our biggest negative weights. You can see from Apple, Canadian CNR, Bank of Montreal, Shopify. You may say, why don't we own Apple at this point in time? Apple's ranking, number one, our other technology stocks always had a higher ranking than Apple over the course of the past year. And Apple's ranking recently has started to come up. In fact, came up higher in January of this year. We're going to wait till next week, till earnings come out January 28th. The stock's done really well. It's discounted a lot of the good news. And we're going to wait and see. We're going to wait till we see how the earnings fare next week before we make a decision to maybe get in. But I'll give you an example of why we're a little concerned about Apple longer term. It's a great phone, customer loyalty, everything. But the 1990s were driven. It was sort of the decade of PCs, and the first decade of the century, 2000, 2010, was driven by the internet. And this last decade was really the decade of a smartphone. Everybody's got their phones, they're walking around them. The next decade is going to be a decade of AI. And we don't think that Apple is there yet, and they're way behind Google. Google's going to connect the whole world together in terms of the internet of everything. Their AI is way advanced over everybody else. So they do have a lot of brand loyalty, and they're trying to actually get people into their ecosystem and charge them a lot of money to stay in that system. But we'll see where it goes from here. We're waiting to see the numbers on January 28th. Looking at the fixed income side, just quickly, Ian's going to talk more about this. We've been in this new normal for 10 years. We started talking about it in 2008, 2009. And what happened effectively is governments around the world and central banks around the world started buying bonds, their government bonds, in order to print money and just have bought the whole market. And if you look at all of Europe now, for example, all of Europe has negative interest rates across the whole yield curve. And prior to 2010, real bond rates are simply the nominal rate of bonds less inflation. You got about 2% above inflation for holding bonds. Now, over the past 10 years, you're getting around 0.5%. And right now, it's almost zero at this point in time. So we're still stuck in this new normal. We don't know when we're going to get out of this new normal. There's inflationary pressures aren't there. There's a lot of debt in the economy. So the economy can't sustain higher interest rates. It'll shut the economy down. So we're thinking we're in this place for some time. The European rates are definitely hanging on this. And so we think we're in this range for some time. And a big challenge for investors and money managers like us is trying to get some yield in the portfolio. It's very difficult. And if you look at the 10-year Canada right now, it's 1.5%. And that's why we created our dividend strategy as a bond proxy to get more return, more carry, and it's loved by a lot of our clients, especially our institutional clients on the foundation side. So people are always hunting for new yield in a challenge for us. And because of that, we're launching a new bond fund. We're calling it our Global Macro Bond Fund. And it's going to be driven, we're going to utilize US ETFs. It's going to be a US dollar denominated fund. It's going to be, we're going to be able to go hunting anywhere we want in the world, effectively looking at US yield, looking at the high yield market, which is yielding probably around 5% right now. We're also looking at emerging market debt on an opportunistic basis. That's yielding around 6% right now, and also US corporations. So it's a form of getting higher yield for us and for our clients, and also diversification out of Canada. We're also cognizant of some of the issues going on in Alberta with potential sovereignty issues there. And we think this could be a place for some of our clients to find safe harbor if there are any kind of issues there. So as well, a lot of our clients take vacations down south. They want to have US dollar exposure, and it makes sense for us to have some US exposure in our fixed income mandates. So you can see what we have up here is US Treasuries, the Canadian total market or aggregate market, and the US corporate market. And you can see emerging market and US high yield. And obviously emerging market and high yield have done better, but they are more volatile, obviously. You can see how they were thumped when the downturn came. But longer term, they have a higher carry. And most of that carry is what you earn effectively. There's going to be losses within those, but typically you earn your carry over time. So we think it's a great place to get diversification for our clients. And as well as playing US corporates and also US Treasuries. And, US Treasuries, when there's a downturn, actually go up. You can see, for example, in 2008, 2009, they actually went up in value when the rest of the world was falling. So it's the safest haven in the world when times are rough. And we think mixing those together, using our dynamics and active strategies, we can add more value on top of that. So it's just another thing we have in our arsenal in terms of getting yield. We have our dividend strategy. We have our corporate bonds. Now we'll have this global macro fund. And also our mortgage fund as well, which gives our clients more carry. And Ian's going to tell us more about that now and how he's doing a great job in Canadian bonds.
Thank you, Wayne. That was a perfect setup. It made my job quite easy. What I want to talk about today, I'll do a quick review of what went on in 2019, talk about some of the characteristics of the Genus portfolios, including mortgages, and then a very brief outlook on where we see things going with a couple of charts. So it was a volatile year in 2019. This is showing the Canadian yield curves. So the interest rates going from 3 months all the way out to 30 years. The gray line is where we started the year last December, 31st. The blue line is where we ended the year, and the magenta line is that was September 30th. But effectively, yields fell throughout the year. Started with Canadian 10 years just under 2%, ended at about 172, so down overall in the year. But actually, if you look at those dotted lines, that shows where the yields actually traversed throughout the year. And in August, we hit 109 in Canadian 10 years. So it was that was at the height of the China-U.S. trade tensions and tit for tat and whatnot. But so it was a volatile year, but overall a pretty positive year for bonds. I'd like to say it was kind of the everything rally. So we had stocks giving great returns last year, and unusually bond returns were quite strong. So just the universe benchmark index was up 6.7%, which is quite a bit more than we would have thought. There you go. So you can see the gray bars are the year-over-year numbers, and the blue bars are the last quarter. So we did see interest rates rise in Q4, pushing up slightly just on some resolution of those trade tensions. I think that was a big uncertainty that was weighing on the market. It was keeping rates lower than maybe where they should have been. So once some of that trade tension uncertainty was lifted, we did see yields rise in Q4. The other side of the coin, though, is credit spreads, and corporate credit was quite strong. It was that risk-on environment with the positive returns in equities. We also saw very positive returns in corporate bonds, and so provincial and corporate credit were two of the strongest sectors in the Canadian bond market. The good news for Genus clients is we have a heavy focus towards credit, corporate and provincial. So this is the sort of suite of funds that are available and used in different combinations, permutations for the clients. Other than the short-term and the government bond fund, the other ones are very credit-focused, effectively all corporate bonds. And obviously the mortgages are Canadian commercial mortgages. You can see just the 1 and 4 year returns, just to give you an idea. Duration is a measure of interest rate risk. So as you have a higher duration, that's taking more interest rate risk, and the yield, of course. So the strategic bond fund is 100% corporate focused, and it's actually in midterm corporates. So sort of 5 to 10 years are what we call the midterm. It has a little more interest rate risk, so with a 6 year plus duration, but offering a pretty attractive yield and pretty good returns for the 1 year at over 8%. That's pretty impressive for bonds, I would say. Commercial mortgages is sort of the other side of the coin, where it's shorter. They're generally writing 5-year mortgages. So the average duration or term to maturity is only about 3 years in the portfolio. But you get this great yield. It offers approximately 175 to 200 basis points over the Government Canada 5-year. and very low volatility. So its job is to just not take a lot of interest rate risk and just crank out that yield. And it's done very well in that respect. Highlight a couple of credits in the portfolio. So we do have, at Addenda, we incorporate ESG research into our corporate credit process. And we're also looking for what we call impact securities. And I think Mike is going to talk about that a little bit more. But impact is where you have a positive, measurable impact across a number of focus areas. Climate change or the environment would be one of those focus areas. So just, I don't need to go into a lot of detail, but Algonquin Power, they're listed on the stock exchange, but they also issued some green bonds, and they're really into renewable energy. And it's been a very strong performer for us. And also Sun Life, interestingly, as a corporate, did a green a sustainability bond, effectively raising funds which will be directed towards projects that are related to climate and energy efficiency, renewable energy. This is just a couple, but we also have, I'd say, a fair number of other investments which are exposed to infrastructure. We've gone into, it started about 10 years ago, what we call P3s. It's public-private partnerships, where you're raising debt from the public entities, but you've also got a private sponsorship. So an example would be McGill Hospital in Montreal. McGill always had, very old school, always had an on-the-campus hospital, Royal Victoria. It was quite dated. They, about 7 years ago, started to build $1 billion new hospital. So that was funded with about $800 million of public debt, with which your portfolio would be involved in. The money was also put up equity from a project co. And then ultimately, once the hospital's built, the province takes over all the debt payments and they just pay down the debt. And once the debt is paid down, it was long-term debt, the province owns the hospital. So it worked out for us. We get a great yield. We get a fairly strong counterparty risk on the other side, not a lot of risk. You have some project risk as they're building the hospital and whatnot. But we've got a number of investments like that in the portfolio, as well as some real estate.
How is the Sun Life bond trading off the Sun Life credit?
So right now it's trading a little bit through. And what we've seen with some of the green bonds and some of the these impact bonds, they're fairly scarce. They're sort of like, and they're very collectible. So there's a lot of demand for them these days. So we have been typically able to buy them at the same spread as their non-green counterpart, if you will. But we've seen that spread narrow. So basically we've seen outperformance from these impact securities.
Can you just give your thoughts on the overall growth in the ESG space within the bond market as you see it?
That's a very broad question, Wayne. I think it's growing significantly. There's certainly a lot of, I think there's a lot of investment managers that are jumping on the bandwagon. I think some of them are greenwashing, where they're saying they're doing it, but they're not actually walking the walk. I think at Genus and at Addenda, we really do walk the walk. We are actually doing it. We have teams in place. We have built our reputation as having a demand for this product, so we're now getting the first call. That being said, I think last year, I don't have the numbers, but it was the biggest issuance we've seen of impact in green bonds in Canada and globally. So I think as the demand has come, now you're seeing corporations or other quasi-governments, sovereign governments, world banks and whatnot, raising debt to feed that demand. So I think it's just going to keep growing. But we've also seen outperformance where these securities, I think they get bought and they kind of get closeted away and they don't trade a lot. They're very closely held. So there's always demand and there's not a lot of new offers of securities in the secondary market. Talk about the mortgage portfolio a little bit. So it's a Canadian commercial mortgage portfolio, diversified by across geography and across property type. We do not buy any hotels fund or loan to any hotels or residential mortgages. It's really those main property types. Retail, we do have multifamily residential. That's what that means, like apartment complexes and whatnot. As I mentioned, it's very low loan to value. It has a 57% is loan to value. So that's the average of the loan versus the equity of the underlying underwritten loan. And that's been the case forever. So our guys don't, this would be like a AAA mortgage portfolio. It is unrated, but they don't take a lot of risks. Only first mortgages. They don't do any other co-mortgages and whatnot. No B pieces, no alt blending, and very, very high quality. That being said, you could get more spread if you went in some of the lower quality stuff, but that's not the process that they use. So about 175 to 200 basis points over Government Canada 5 years, sort of the average yield. As I mentioned, the portfolio is relatively short-term in nature. They're writing 5-year mortgages. So you have about a third of the portfolio that matures every year. So we think this could be very defensive in a rising rate environment, even though it is affected by interest rates, obviously, as Canada 5-year goes up and down. But you've also got that whole third of the portfolio that matures every year, and then it's being reinvested, so if rates go higher. So it's proved to be very defensive in many rate environments. That's it for the review. I thought just to talk a little bit about our outlook. Really 3 themes, and I think they'll dovetail what Justin and Wayne have said, is support, which is central bank monetary policy, valuation, which is somewhat stretched in credit markets, but we think can continue, and finally risks. So for us, we've got extremely easy monetary policy going on around the world. Arguably the Fed and the Bank of Canada, and I'll show you the Bank of Canada, we're not as easy as others. We haven't gone to negative rates or 0 rates, knock on wood, that's a good thing. But still very supportive and accommodative monetary policy. There is very limited scope, I think, as Justin mentioned, that we'll see central banks tightening this year, maybe in 2021, depending how the economy evolves. But for where we are now, the Bank of Canada just announced no change today in their monetary policy. And in their outlook, they actually downgraded their growth outlook for Canada. Just a couple of tenths, but I don't have a feeling that they're in a tightening mode. If anything, they may actually be easing. In that easy monetary environment, it's usually good for risk assets, for equities, for high yield, emerging market, and also just corporate credit in general. So that's where we are in the Genus portfolios with that focus. And we think that this will continue. Now, that being said, we saw credit spreads narrow or get lower throughout 2019. It was a risk-on year. So there's not as compelling of an argument to get into as, say, there was in January of last year, of 2019. But it's still, we think it will continue based on that strong support. And again, it's demand for yield. So you've got investors clamoring for where can I get that yield? And generally, corporate bonds have been in favor. Certainly risks, I think we're all well aware of the geopolitics that are going on. It seems like we've been living with this for many, many years. They kind of come and go. The bond market reacts to them. At this point, it's hard to predict, and it's hard to, the new flu. It's hard to build your portfolios for any one of these. These are somewhat low probability but high impact type events, or very difficult maybe to forecast. So we generally try to look through them and just manage around that volatility. And the other one would be just a shock to consumer confidence. Consumers are the big drivers of economic growth. So we watch very closely what's going on with the consumer debt levels, these type of things. But it's so far so good. Consumers are still in vogue. We're still going. Now, just one final chart to talk about interest rates in general. Justin touched on yield curves. This is showing the top 19 developed markets of the world. So no emerging markets, no Russia, no China, no Brazil. But the red is obviously negative and the green is positive. And you can see there's quite a bit of negative yielding debt out there. Couple of highlights here. The Bank of Canada, in overnight, Bank of Canada at 175 has the highest overnight rate of the developed world. I'm not sure our economy is really that strong to justify that rate. So that's where I would kind of think that there's probably more of a bias to ease. But he's being very patient, that being said. The other thing to note is there's only 2 bonds in the world which have a 2% or greater yield on them, and that's Italian long bonds and U.S. Treasuries, U.S. 30-year Treasuries, just slightly north of 2. And those Italian bonds have been kind of bouncing around a bit. People say our yields are too low in North America. Well, they are relatively low to where we were, but they're not low relative to the rest of the world. And we are seeing capital flow into North America, again, out of Japan, out of Euro, out of these negative yielding sovereigns to come into North American yields. And it's coming in unhedged, so they're taking that currency risk. So, Wayne's discussion about emerging markets, like this is, you don't necessarily want to go and invest here, I don't think, if you're going to go into global bonds. That's a tough market to be. But going into global credit, global high yield, emerging markets, there's still lots of yield there. So I would fully support that idea. I'll leave it on that note. Mike, over to you.
Great. So at Genus, we're very focused on the markets, very focused on our financial models, but we also have really a core focus on impact and the difference that we're making as a firm. So for Genus, we are a certified B Corp, which means we're certified as a company that is striving to be a force for good in society. We have to go through rigorous testing in order to get this. We had to show that we had sustainable products, that we have a diversified workplace, that we're employee-owned, strong sustainability policy. So we're proud to be certified B Corps. And so in terms of the products that we're supplying to clients, we have a suite of fossil-free funds, which have been mentioned a few times. So these are sustainable funds. But the area that we're going to be talking about today is impact investing. So for those that aren't familiar with impact investing is going kind of a step further than sustainable investing. So with impact investing, we are trying to achieve our financial goals, but also make an impact at the same time. So instead of just taking out the bad stuff out of your portfolio, you're putting in the good stuff. So instead of just taking out tobacco, or maybe you want to take out gambling or fossil fuels or something like that out of your portfolio because you don't agree with that, you want to align your portfolio with your values, you're putting in maybe innovative healthcare companies or renewable energy, so that you can make an impact on society, on the environment, while also meeting your financial goals. And we see impact investing not only as a way to make a difference, a way to activate more of your capital to do good, but we also see impact investing as a hedge against big changes that are happening in our society, in our environment, one of those being climate change. So with climate change, there are large physical risks. So of course, we're seeing fires, floods, changes in weather patterns. But then there's also large transitional risk. So our economy is quickly changing to be more low carbon. There's more policies coming out by governments around the world around climate change. Of course, there's a carbon tax. And this is a large risk for a lot of companies and for a lot of portfolios, because a lot of portfolios are invested in companies that won't be able to transition as fast as everything's moving. So we see this impact fund as really a hedge against that. So you can make a difference, but this impact fund is probably going to benefit from these transitional changes. So that's quite a strong benefit for clients. So at Genus, we have a high impact public equity fund. So this is a fully liquid fund investing in public equities. And then we also, just about a year and a half ago, maybe 2 years ago, started the Genus SVX Impact Investment Council, which is more investing in private issuances. So we're investing in private equity, venture capital, private debt, infrastructure. But today we're going to focus more on the public equity side. So when we're looking at impact, it's very important to measure the impact that you're making. You don't just want to say that you're making impact and just feel good about that. You need to measure what you're doing. And so we've talked to a lot of our foundation clients, and the way that they're measuring their impact, many of them, is looking at sustainable development goals. So as I think Ian mentioned before, the Sustainable Development Goals, or SDGs, were created in 2015 by the UN. And so there's 17 goals that the UN is encouraging governments, organizations, companies to strive to accomplish. So some of these goals are good health and well-being, quality education, affordable clean energy. So when we're looking at our public equity high impact fund, we're making sure that each of the investments that go into that fund are contributing towards one of these goals. Usually they're contributing towards many of these goals, but they at least need to have a significant part of their business contributing towards these goals. And we have 3 different data providers that verify the impact that we're making for us. So that it's not just us thinking that we're making impact with these stocks. We have outside sources verifying this. And then if we look at the 17 sustainable development goals and look at the number of stocks within our public equity high impact fund that are contributing towards that goal, this is the chart we have. So we have so some of the goals, such as climate action, decent work and economic growth, affordable and clean energy, we have a significant number of stocks that are contributing towards these goals. So with climate action, 25 of our stocks are contributing towards that goal, and we only have 33 in the portfolio, so it's quite significant. Of course, there's some goals that are much more difficult for for companies to try and contribute towards, such as peace and justice, strong institutions. It's hard to find investments in that area, but there are other areas where we feel like the companies that we invest in can make a big difference. And then here's just a list of the companies in our portfolio. I'm certainly not going to go through all this, but we just wanted to show you that all of the companies within our high impact portfolio are contributing towards at least 2 different sustainable development goals. And so there's a list of the companies and the goals that they're contributing towards. And I'll jump into a few of our top holdings here, just to give you examples of what an impactful company or impactful stock would be. So first of all, Vestas Wind. So Vestas Wind is a company out of Denmark. They design, they manufacture, they install, they maintain wind turbines around the world. And they're really a leader and an innovator in that space. So about 18% of the total world's capacity for wind energy has been installed by Vestas. And they're really cleaning up their supply chain. So not only making sure that their products are sustainable, that them as a company are sustainable, but they're making sure that companies that are supplying them are also sustainable. And they have some zero net carbon goals for the future as well for their supply chain. Next, we have Kingspan Group. So this is another top holding within our impact fund. So Kingspan Group sells sustainable building products. So they sell things. They sell products like energy or building retrofit products in order to lower the energy consumption of buildings. They have insulation for buildings so that buildings can be more energy efficient. They have water conservation technologies, energy conservation technologies that they're selling to builders. And then we also have Bristol Myers. So Bristol Myers, many of you may be familiar with. They spend about $5 billion per year in research and development to find solutions for major diseases around the world. And they have many pharmaceuticals, medicine solutions for many of the major diseases. And something that we really like about Bristol Myers is that they have a great program within poorer countries, within developing countries. They have very affordable pricing systems for developing countries. They also do a lot of capacity building for researchers, governments, and companies within developing countries to help them with finding solutions to major diseases within those countries in an affordable way. And then next we have Microsoft. So Microsoft probably isn't a company that you think about impact when you hear Microsoft, but they've really made a big transition, especially over the last decade, to become quite an impactful company. So a significant business line for Microsoft is their cloud computing. And cloud computing is much more energy efficient than local computing, so they're really contributing towards climate action with their cloud computing products, and that's one of the fastest growing parts of their business. They're also significant in education, and also with increasing productivity of employees, of workers around the world. And then finally, we have Berkeley Group. So Berkeley Group is a UK-based home builder. And so they are quite a leader when it comes to sustainable home building in the UK and globally. So about 73% of the homes that they build are using either renewable energy or really low carbon energy. And in the next decade, they want to have that 100%. So all of the buildings that they're building are going to be relying on renewable energy. So quite a leader in that space. So those are some of the holdings. And then as a portfolio, we're also trying to measure the impact that we're able to make for clients within this fund. And so we want to measure that against our benchmark. So when we're looking at financial performance, we want to measure against the benchmark. When we look at impact performance, we also want to measure. So the way that we do that is we look at the percentage of revenue of the average company in the portfolio that is made from impactful products or services. So a company like Vestas Wind makes 100% of its revenue from impactful products. But then there's other companies that may just have a significant business line, but not their whole business that is really impactful. So maybe 20% of their revenue comes from impactful products. But we want the average revenue from impactful products to be over 50%. And right now within our Genus High Impact Fund, we have 57% of the revenue coming from from impact versus the MSCI World Index, which is the benchmark for this fund, which is 11%. So it's significantly higher than the benchmark, and something that many of our clients are quite excited about that are invested in this. So impact investing in general and our impact fund is something that we're quite excited about, that we're quite passionate about. And now we have a 5-year track record for this public equity high impact fund. So it's kind of gaining even more steam. And it's something that a lot of our clients are excited about because not only, as I said, they can hedge against things like climate change, but they can also use it to activate more of their capital to really make a difference. Okay, so now for Leslie to talk about positioning.
Well, thank you. Thank you, everybody. You did a great job, I think. I get to end with, so how'd you do? And of course, last year was a great year in the markets, in the bond market and the stock market. So it was a great year for our clients. But before I get there, I'll just talk about how your portfolio is positioned versus a year ago. As you might imagine, we're more optimistic now than we were a year ago. So you have less cash in your portfolio and more stocks. So the policy for our balanced fund, which may not be you, our balanced fund is about 60%, 65% of all our clients. They're the clients that we call normal. They want everything. They want growth, they want safety, and they want income. And those kinds of people are in a diversified portfolio called our balanced portfolio, which is this. Some of you may be more growth-oriented or even more conservative. But this is about 65% of our clients, so it's a good example to show you. So the policy of this balanced client is 60% stocks, 40% fixed income. A year ago, we were 59% stocks, slightly below, but a big weight in cash, 11%. That was the largest we've been in 30 years. Now today, the equity weight is 66%, so quite a bit above the benchmark of 60. But I should say a lot of those stocks, the 66% in stocks, are not high beta stocks. So when you adjust those stocks for their beta, it's actually more like 60% because so many of those stocks are so conservative. So we're really kind of just on the benchmark, even though when you look at your portfolio, it looks like you're overweight stocks. You all know that about 10 years ago, we started having seminars from panel of experts. So not investment people, but maybe tax people, estate planning people, other interesting topics. We're thinking about having one in the fall, having an expert from Washington, D.C. to talk about the U.S. coming election. We might do this in June, combine it maybe with Vaughn Palmer or Michael Smith and talk about the Canadian politics. So those kinds of seminars that are from experts that not about investments. And we're so happy to be in this building and have this second floor to have all these seminars here. So that's our annual review. Thank you so much for coming. And thank you so much. There's about the same number of people online, about 50, as are in the audience today. So it's our first year of being online. So we hope the technology worked well. And now it's your chance. We'd love to get some questions about any of the topics, if anything is of interest to you. Russ, just hold on just so that people online can hear you.
My question relates to the chart that Ian McKinnon put up, and it had to do with the negative yields that seem to be mostly in Europe. Is there a particular reason why this is happening in that part of the world as opposed to in the United States or Australia or Canada?
I think I might. What really happened, I think Europe led the way with the negative yields. The ECB, Switzerland, they moved negative. Switzerland was a currency thing. They were seeing a lot of money pouring into their currency, so they tried to really ease their yields to sort of relinquish some pressure on the krona. But what it was really the concerns about inflation and disinflation. So the ECB, like the Bank of Canada, has that price stability target, and they have just not been able to generate any inflation. And they're very worried about what's been going on in Japan, where you've had this sort of persistent disinflation and or deflation, which kind of gets consumers to just pull back. It really weighs on your economic growth. If you think you can buy something next year and it's going to be cheaper than it is this year, you often put off that decision to make that purchase. So disinflation is really, I think, generally accepted economically, Justin helped me out here, but as being very negative for economic growth. So the European Central Bank really fighting that and actually pushing yields negative. Now, there's no negative I think there might be one. They're not doing negative coupons on their bonds. What they're doing is they're putting a slight positive interest rate on the bond, but then issuing it at a premium, so it actually matures at a lower value to generate that negative yield.
Oh, you can buy a capital loss. That sounds good. Any tax people in the audience?
Doesn't work for me.
Hold on, Kirk. We just you'll be next. From behind the pillar.
Are you at all concerned about the fact that the Canadian yield curve has remained inverted for about the past year, as opposed to the U.S. curve, which normalized last year? What the impact on the Canadian economy that might?
I don't think it's inverted right now. It was, as they both were. Oh, it's inverted now. Ian, you should answer.
The quick answer is yes. The bond market is telling you with an inverted yield curve that they think that the Bank of Canada is too tight. Now, the bond market can get excited and go too far one way and too far the other way, but that's what the market's telling you, that they think that the Bank of Canada at 175 on their overnight rate, and we've got Canadian 10 years at 145 to 150, telling you that the bank is too tight. It has a very high correlation as a recession indicator, but it's not a good timing element. So we can skate through, and we've seen it go negative, and then you can bounce back positive. What happened in the U.S., as Justin pointed out, the Federal Reserve was able to re-steepen the curve, or revert the curve, if you will, and get it back into a positive by easing up on short-term rates and also by buying a fair bit of T-bills in the repo market. The Bank of Canada has been stubbornly patient and not moving on his interest rate. And I think that you will probably see there's more risk that he cuts rates this year just to address that inverted yield curve.
Thank you. And so I'm a conspiracist. Does the strength of the Canadian banks, they love higher interest rates. Do they have any influence on the Bank of Canada to keep that short rate high?
Arguably, no. I mean, but perhaps.
Anyways.
Certainly, yeah. And that's where this negative yielding thing is a real problem for the banking model in Europe, right? So I think North American central banks have been conscious of that and tried to keep rates maybe a little more positive.
Great. Kirk, maybe just hold on for the mic.
I have a simple explanation for that chart, and that is that the green zone there at the bottom are all English-speaking countries. Simple, facetious comment, obviously. My real question is back to exchange rates. What are you seeing in forecasting in terms of Canadian-U.S. exchange, or U.S. dollar, for example, relative to Canada, relative to euro?
We'll let Wayne do that. He gets the easy ones.
Yeah, I'll call for help on this one. Yeah, our model, as I showed you right now, is a bit red, bit negative on the Canadian dollar. I think, though, as our view longer term is a stronger global economy, that'll help Canada, I think, longer term, as it'll push oil prices up. There's the former governor of the Bank of Canada, what's his name? Not Carney, the one after that. Not the one after, but before that. Anyways, a former governor of the Bank of Canada just came out and said that we actually are understating economic growth in Canada, and that could have a bearing, I think, too, on their policy. But we're not really measuring a lot of the technology, the software development space that well. We're losing, how many points are we losing, did you say? Almost 50 basis points in GDP growth per annum is being understated from that perspective. We're not measuring some of this new technology space. Just today, I heard an announcement of the Oxford Development is going to build 37 new high-rises in Mississauga, develop a whole new cityscape there. So we're really being propelled by this whole real estate boom. Not so much here in Vancouver, but more in Toronto, which is a concern longer term, obviously. I still think longer term, the global economy is going to turn around. One thing that's really bothered me about our call for recession last year and the inverted yield curve was this cycle wasn't typical of previous past cycles. We never really had a big blow off where economies really got hot and overheated. Never really happened. I still think that has to happen before we get another recession. And so in those kind of environments, Canada will do well, I believe. And as well, we're tied to the U.S. If the U.S. does well this year, and if the Fed's on pause through the election year, they're going to drag us along. And maybe that's part of why the central bank's holding their ammunition. The central bank here is very good. It's one of the best central banks in the world in terms of forecasting, and they usually get it right.
Well, that was great, but I don't think he answered your question. You should go.
I guess weaker in the near term, but longer term, we think it's going to do fine.
So weak in the near term, longer term, fine. Let's. Yeah. So thank you. We'll do one more, Marg, if you have a question, or one in the back too. Two more questions.
It's forward-looking concerning the norovirus or the coronavirus or whatever they're calling this new virus, and markets have reacted with the escalation in the number of cases. How would this impact the global economy if it becomes like a SARS-like, epidemic?
I don't have previous experience in my back pocket, but it's the first reaction from the market yesterday was to hit a lot of the economic sensitive issues. Right off, just the first impulse is to whack that, slow down travel. It'll hit the cruise lines, the airplanes. Air Canada was down 4 or 5% yesterday. So there's issues around travel and the economy, obviously. They seem to be getting on top of it, I guess, fast. And it doesn't seem to be, at least so far, the ratio of deaths to reported events is much lower than SARS. So it's a concern, but it definitely would tamper down economic growth and a lot of the cruise lines and the vacation area, for example, and hurt there.
Okay, one more in the back. Hold on just a sec. Let's get you the mic.
I think it's for Mike. Thanks for the impact fund stuff. I was curious about, I don't know if I saw it or maybe you said it, how it's doing in terms of performance. And I really appreciate you saying that the rest of them are greenwash products and the quality might not be there in terms of SDGs. So it was good to see the 57%, but how is it comparing? And everyone just criticizes impact or ESG products being less than other returns. So just wanted to see if you can comment on that.
Sure. So so the impact fund has been for the past 5 years has been performing about 1% lower than the benchmark, and I don't think that's a function of investing for good means lower returns. I think that's a function of a lot of right now a lot of the most impactful companies have been in Europe, and Europe I think we saw some charts before. Europe hasn't performed as well as the rest of the world. So because of that, it hasn't been able to perform. But I don't think that that's going to be what's going to happen in the long run. I think, as I said before, in the long run, I think this is a great hedge for climate change and some big transitions. So, but it has underperformed slightly over the past 5 years.
The numbers are 10.5 and 11.5. So they're still two good numbers. Anyways, I'm going to call an end to this. But please, if you have more questions, come approach us. We'd love to talk to you and really appreciate you coming out. And thank you very, very much.